Hello young Padawans. In this last video for Unit 4, we are going to once again talk about revenue. In an earlier video, we talked about all the new ways sports teams are making revenue. But we really need to know what it is and how it works in business. It's important to understand that money is why so many things happen in the sports and entertainment industry. I mean, I'm making big bucks on these videos. I said bucks, not ducks. Revenue is the amount of money brought into a company by its business activities. It is a company's income. Revenue generates from the sale of goods and services or any other use of capital or assets. It is calculated before any cost or expenses are deducted. To make it, you need a revenue stream. A revenue stream refers to the amount of money coming into a business or organization from a particular source. A revenue stream can be used to describe revenue generated from each customer segment. Its calculation is extremely important to a business in order to assure a stable income for the company. Revenue can be divided into two categories: transaction revenue and recurring revenue. Transaction revenues earned from the customer making a one-time payment for a product or service. Recurring revenue are revenues earned from consistent ongoing payment, which is highly likely to continue in the future. Remember, the goal of sports business is to make a profit. A profit is a financial gain when the amount of revenue gained from a business activity exceed the expenses, costs, and taxes. Examples in sports and entertainment industry include, over the past 20 or 30 years, the major trend in sports has been the tremendous growth in revenues, primed by television broadcast of games, followed by increased advertising sales, sponsorship, and stadium naming rights. Businesses want to avoid a loss. A loss is the opposite of profit and a reduction in the value in which a company's expenses exceed its revenue. What's an example of a loss? Amazon Books, an online bookseller founded in 1994, reported a loss every year until 2003, when it finally produced its first annual profit. Companies have to produce a profit and loss statement. A profit and loss statement is a financial statement which summarizes the revenues, costs, and expenses. Profit loss statements are incurred during a specific period of time, often a fiscal quarter or a year. It is commonly referred to as an income statement. It begins with an entry for revenue. It subtracts the cost of conducting business, which include the cost of goods sold, operating expenses, tax expenses, and interest expenses. It also includes the net income in the bottom line. Start that over. Okay, so that's my video on what is revenue. Remember to read through the Schoology page for more information. The vocabulary appears in red. Be sure to work on your Module 3 activity and your unit project, and be ready to take your Unit 4 test. Until next time, young Padawans, may the Force be with you.